Hi everyone. Thank you so much for dialing in. I'll do a quick intro of NSRCEL before we get started with the actual webinar. So for those of you who are joining us for the first time, let me quickly introduce NSRCEL to you. We are the startup incubator at IIM Bangalore, and we've been around since I think almost for about 25 years now, since about 99 to 2000. That was when the incubator was started. And so we've been around for about 25 years now. And we run 14 different programs in a year. They span various sectors. We also have sector agnostic incubation programs called Launchpad and Velocity. Launchpad is an idea stage incubation program that runs 3 months long, and Velocity is a growth stage revenue stage incubation program that runs about 6 to 9 months long. We also have sector focused programs in the spaces of social impact, women entrepreneurship, mobility, sustainable mobility, even sustainability, like a climate tech hub with Hindustan Unilever Limited. We also have an upcoming fintech program. So if any of these are of interest, you should certainly check them out on the NSRCEL website. You can always drop us an email, and if you have any queries about, what program is the right fit for you, and we'll be able to get back to you very quickly and maybe even set up a call with the program team for you to understand whether it's the right fit for you. So that being said, this is also a link tree you can access. You can just scan and you will get access to a couple of links, one of them being this WhatsApp channel that we run called In the Loop with NSRCEL. So In the Loop with NSRCEL essentially grants you access to all of the call for applications, any events we're doing, any webinars we're doing, all of that goes onto that channel. It's essentially for founders who wish to stay connected with what we're doing at NSRCEL. And it also has the link to all of our other social media profiles so that you can stay connected with what NSRCEL is doing. Yeah, so I just wanted to keep it a short intro so that we don't take time from, we don't borrow against the webinar. Today we have Vikrant Portnes, the founder of Fund Enable, joining us for a session on startup valuations. So yes, thank you so much, Vikrant, for taking the time out to do this, and over to you.
Thank you. Welcome everyone to today's webinar on valuations, right? And I'm going to just start sharing my screen. Perfect. So before we begin, a very quick introduction about myself. My name is Vikrant. I am the founder of Fund Enable. At Fund Enable, what we do is we invest in startups and we raise multiple rounds of funding for our portfolio companies. So that's the proposition. In my understanding, in my experience of running businesses, exiting businesses, scaling businesses, there are four core pillars of running a venture. There is product, which all of us are building. There is go to market. We have to take that product to customers. There is putting together a solid team. So team is the third pillar. And fourth is capital. So what we do at Fund Enable is we'll invest a small round. We'll put in a small check at the seed or pre-series A level. And then we'll ensure that our companies raise multiple rounds of funding going forward. Prior to starting Fund Enable, I exited a business in the asset leasing space. And in 2018, Fund Enable is my second venture. The first venture was bought out by our own investors. We raised 4 rounds of funding and the investors took over the company. And before that, I used to be a part of JP Morgan's India investment banking team and a fund called Springboard Ventures. Teaching is my passion. So far, I've trained over 2,000 founders in how does one go about raising a round of capital, and also over 500 investors through a program called Angel School, which I run with Venture Catalyst, which is India's largest angel platform. From an educational background standpoint, I've done my engineering and then my specialization through Cornell in entrepreneurship and finance. I teach across business schools. The only topic that I know is how to raise a round of capital and how to scale companies. These are some of my portfolio companies. This is a company called eMotorrad, which is based in Pune. I met them through an incubation program. We started working with them and invested when they were looking to raise 1 crore rupees of capital. Post that, we raised $4 million of funding for eMotorrad from a US-based climate impact fund called Green Frontier Capital. And post that, around 160 crore rupees were raised through a fund called Panthera, based out of Singapore. And just before last year's IPL, MS Dhoni invested in this company, and MS Dhoni is also the brand ambassador of the company. And before every IPL, the company comes up with an ad with MS Dhoni. In fact, just before this year's IPL, also we came up with an ad with MS Dhoni, and that is what this company has been able to do in a span of 3.5 years, from that 1 crore of investment to today, raising over 200 crore rupees of funding and reaching a turnover of almost over 250 crore rupees in a span of 3.5, 4 years. Another company in my portfolio is a company called Work India. So what Naukri.com does for white collar jobs or for software accounting jobs, Work India does the same thing, but for security guards, telecallers, field sales guys, your riders, right, delivery boys. So when Swiggy's of the world, Zepto's of the world, they are hiring thousands of delivery boys every month. Platforms like Work India are actually catering to them. So again, met them through an incubator program. They when they were looking to raise around 1.5 crore rupees of funding, that's when we entered. And post that, we've raised 6 rounds of funding for the company. The last one was a $12 million round from a bunch of investors. So over again, almost 100 crore rupees raised for this particular company, starting with a very small round when we entered. And there are lots of companies in the portfolio. I'm not going to talk about each one of them. Um, Coming to today's topic, which is valuation, right? And it is one of the most, I would say, misunderstood topic in the early stage ecosystem. I'm going to break down valuation discussion in two parts. One for companies, for startups which are generating some revenue, and the second one for startups which have not started generating revenue, or you have not been able to strike a deal with the investor because of the valuation issue, right? So the entire discussion is going to be broken into two parts. First, we will talk about valuing companies which have some bit of revenue, and the next we will talk about companies which are not making any revenue. So what is basically valuation? What do we really mean by valuation? Valuation is nothing but 100% worth of the company, right? Today, what is your company worth? If we put together all shares, right? If we put together, if we attribute a value to your business right now, as we speak, what would that be? And how would we find valuation? It's very important because the correlation between the capital that you're looking to raise and the percentage stake that you're going to offer to the investor, that correlation is basically valuation, right? So if I'm looking to raise $1 million or let's say 5 crores, how much stake today should I offer to the investor? Should I offer 5%, 10%, 15%? That correlation essentially is what we call as valuation per se, right? Now, how do we find valuation? Then I'm going to teach you a couple of methods. And one of the methods that is very widely used in the early stage ecosystem is what we call as market multiple or transaction comparable method, right? This is by far the most, I would say, used method in early stage ecosystem to find out what is the valuation of the companies. So in transaction comparable method, we actually are dependent on a metric, and this metric is called revenue multiple. So what is a revenue multiple, right? Revenue multiple is basically nothing but valuation of the company divided by the revenue of the company. So you would have come across this. Revenue multiple is valuation divided by revenue. So let's say I got a valuation of 10 crores, and at that point in time, my revenue was 1 crore. Then my revenue multiple was 10x. In other words, my valuation was 10 times of my revenue. So this equation is what we use for calculating valuation. How are we going to do that? I'm going to talk about it. Right? What we are going to do essentially is, try to figure out this revenue multiple for our sector, and then figure out what will be the valuation of our company. But one question that comes to our mind is why revenue? Why are startups valued on the basis of revenue? Why not on the basis of EBITDA, or why not on the basis of profitability? It is because the stage at which we are, either we are not yet profitable or we have not hit steady state profitability. We might have hit profitability, but it is not at a steady state. It is not at a normal state per se, right? So therefore, the only financial metric which is available at this point in time to come up with some valuation is revenue. And therefore, revenue is very, very critical when it comes to startups for valuations. As the company grows, EBITDA becomes important, right? Your operating profit. And as you become very large, like a listed company will get valued on their profitability or PAT, right? So as the business grows from revenue, you move to EBITDA, you move to profitability in terms of the valuation metric or whatever valuation is dependent on, right? So rather than going through the theory part, let me just quickly take you through an example. And this is again a live example that I'm going to talk about. Here is a company, and what that company does, this company has basically created a probe that goes inside the field, right? A farmer basically inserts that in the soil. And what it does is it monitors the parameters of the soil, the moisture content, the NPK, values of the soil. All of that gets monitored. And then it takes intelligent decisions. So let's say if the moisture content of the soil has dropped, then irrigation taps will be opened automatically for the next 20 minutes or 30 minutes, right? If NPK values drop, then possibly a drone is activated and it sprays a particular fertilizer for the next 15 minutes per se, right? So it's a smart IoT technology for managing your farm per se. Now, this company is currently doing a monthly revenue of around 4 lakh rupees. So, consistently over the past 2-3 months, the company is touching around 4 lakh rupees per month. And this number is what we call as MRR, or monthly recurring revenue, or a lot of times people also call it monthly revenue run rate, but it's essentially monthly recurring revenue. That what am I making per month on an average, and take the past 2-3 months data and see what kind of revenue are you making without funding, right? This is as you are operating your business, right? Now, what you can do is you can annualize that number. How do you annualize that number? You multiply that with 12 months in a year, and what you get is annual recurring revenue or annualized revenue run rate, which is coming out to around 48 lakh rupees in this case, right? So, what is happening? This startup would go and tell investors that, boss, I am today at an ARR of 50 lakh rupees, around 50 lakh rupees, right? So that startup would not say that, oh, you know what, last month I did 4 lakh, this month I did this. No, they would just say that today I'm doing an ARR of around 48 lakh rupees. Now, if your business is seasonal, then adjust that number. Basically, ARR is very different from your projections. Okay. So projected number is what you will make. It's on Excel sheet. Your past number is what you did last year. But ARR is what you are essentially doing at this point in time, right? And that is what is important to understand. What if I continue to, make 4 lakh rupees on a monthly basis, the rate at which I am today, what is the kind of revenue that I'll be able to make? That is what this number says. So Nikita is asking, is ARR on a gross revenue or gross sale basis or a net sale basis? It depends on your business, right? Most of the times, take it on the net revenue per se, right? And obviously, this is again one thing which I possibly am repeating, in a lot of my sessions is do not consider GST as a part of your revenue, right? GST is not a revenue item. It's not a P&L item, right? It is actually a balance sheet item. It is your liability. So don't consider your ARR or your revenue inclusive of GST. It should always be net of GST. Always remember that. Even when you are discussing internally, right? That what is the revenue that you did this month? What is the revenue that you are going to do, next month? Never ever consider GST as a part of your revenue per se, right? Revenue is there's a question that has come up. Revenue means turnover. Yes, right. Turnover is typically a word that we usually associate with with heavy industries, right? But it is essentially the same thing in a way. Now, let's say this company is looking to raise around 1 crore rupees from angels for enhancing technology, for hiring, and for marketing, right? So this company, which is doing around 48 lakh rupees of ARR right now, wants to raise a crore rupees of capital for making their technology better, for hiring more people, for marketing, right? Now, the question that we have in front of us is, against this 1 crore, how much stake should the investor be taking, right? Should the investor be taking, 5% stake, 10% stake, 15% stake? How do we decide that? How much stake should we be giving to the investor? And that is the problem statement that we have at this point in time. So, how to take this forward, right? What is the solution to this? So, what we do is, instead of just coming up with our gut that, oh, you know what, I am okay to give 8% at this point in time, or I'm okay to give only 10% at this point in time, rather than, kind of making the decision based on your feeling or your gut, you first take a pause and you say, let me look at what is happening in the agri IoT space at this point in time. What is happening? Are there any companies that have received funding? If yes, at what valuation? What were their multiples? So we kind of look at the data, the market data to begin with, right? And when I start looking at the data, I get a table like this. How will you get this table? Where I'm going to talk about it. Just concentrate on the numbers at this point in time, right? So there is a company called Farm Agri Solutions, which is kind of similar to me, not completely, but they are also selling technology products to farmers. And this company raised 25 lakh rupees and gave a 12% stake to the investor. So 25 lakh rupees for a 12% stake, which means the valuation of the company was 2.1 crores. So how did I calculate? If 25 lakhs is equivalent to 12%, 100% valuation is equivalent to how much? If you cross multiply, you get 2.1 CR. When it got valued at 2.1 CR, the company was doing a revenue of around 12 lakh rupees at that point in time, right? So now with this data, what I do is I calculate revenue multiple. How do I do that? Valuation, which is 2.1, divided by revenue, which is 0.12, and that comes out to 18x or 18 times, which means Farm Agri Solutions was valued at 18 times of their revenue per se. Similarly, another company called Smart Farm Technologies raised 2 crores, gave 22% stake, which means valuation was 9.1 crores. At that point in time, they were doing around 76 lakh rupees of revenue. So they got a revenue multiple of 12x. So I find out comparable transactions, companies that are not 100% similar to me, you will not possibly get that, but are looking at raising their first round, which is what we are looking to raise. They are in the agri space. They are providing technology solutions to farmers, right? All of those details are to be found. Now, where will we get this data? I'm going to talk about it. Just hang on, right? So now what have I done? With this data, I have taken a median. So if I take the median revenue multiple, I get 16x. Why did I take a median and why did I not take a mean or simple average? So the difference between mean and median, seventh grade or possibly sixth grade mathematics, right? So let me give you an example. Okay, so let's say if we had Bill Gates amongst us attending this class today, and if I ask this question, what is the average net worth or wealth of this class, right? And the number would have been in millions of dollars. Why? Because that one Bill Gates, which is an outlier, is skewing the average. What median does is median will ask Bill Gates to kind of leave the meeting. Then we will ask the same question, and then whatever number we will get will be a much more filtered number, right? And therefore, in all practical purposes, we never take average. We always take median to remove the impact of the outliers. So the median revenue multiple is 16x. Or if an agri IoT company today goes out in the market to raise a round of capital, typically they will get a multiple of around 16 times. Now, the question is, where did I get this data from, right? There are databases uh, whose job is to provide this data to you, right? One of the things that my company also does is to provide this data to investors, startups, etc. So if you go to fundenable.com, you will be able to, have a place where you can actually subscribe to this data. There are a lot of databases. It's not only that Fundenable does it. Traction is there, Venture Intelligence, PitchBook. So multiple databases are available where we just need to put out where we just need to put these drop downs that I am in agri space, I am looking to raise first round of funding. Then you will get a lot of, list of companies. You can possibly go through it, select which ones are relevant, delete the ones that are not relevant, right? And then come up with a comparable 6, 7 names, 5 names, whatever it is, right? You don't need to have 10, 15 names, even 3, 4 names is good enough. And that 3, 4 names will give you a sense of what is the revenue multiple and the median revenue multiple. So this table is straight away downloaded from these databases. Now, what do I do? Very simple. I actually use this revenue multiple, right? I use this revenue multiple of 16x and I put it in my revenue multiple formula. So what is revenue multiple? Again, going back, revenue multiple is nothing but valuation divided by revenue. So what is valuation? Valuation is nothing but revenue multiple multiplied by revenue. Do we know the revenue multiple? Yes, we have just calculated it. Do we know the revenue? Yes, we've just found out the ARR. So what is valuation of the company? Valuation of the company is nothing but revenue multiple multiplied by revenue, or basically 16 multiplied by 48 lakhs, and that comes out to somewhere around 7.5 crores, 7.7 crores. So this is how I have found out the valuation. But this valuation is basically called the pre-money valuation. Why pre-money? Because I have found out the valuation using a revenue which is without any impact of investment going into the business. 48 lakh rupees of ARR is what I'm doing even right now without any single rupee of investment coming through, right? So therefore that number is called before whatever valuation we are getting is before the money has come in. So how do we move from pre-money to post-money? Very simple. Just add the investment amount on your pre-money valuation to get post-money number. So 7.7 crores plus 1 crore is 8.7 crores. And this 8.7 crores is actually your valuation, or what we call as post-money valuation, right? And how do we calculate percentage dilution or percentage stake that you have to give to the investors? Again, very simple. Divide the investment amount by the post-money valuation, and you will get the percentage stake, right? So if you just divide, if you just divide 1 crore by 8.7 crores, then that gives you 11.5% stake. Now, is this number sacrosanct? So Sukanya is asking where did 1 crore come from? 1 crore is the investment amount, right? 1 crore was the amount of capital that we were looking to raise, right? So the money that you are looking to raise, 1 crore, divided by the total valuation of the company, which is 8.7 crores, will give me the percentage dilution, right? So if I'm an agri IoT company doing an ARR of around 48 lakh rupees and getting a multiple of roughly around 16 times, then to raise 1 crore rupees of capital, I have to dilute around 11.5% stake. But this number is not sacrosanct, which means just because I got 11.5% on the Excel sheet does not mean that I'm going to close the deal at that number. This is the starting point for negotiations, right? So you will say, oh, you know what? My product is far better than whatever is available in the market. My team is far more experienced. I have already done this much level of monetization. But is there a way to convert a better team, a better product into a premium number on valuation? No, we can't do that, right? It's purely negotiations. At times, The reverse can also happen. Let's say you want money in your bank account in the next 15 days, right? And you are otherwise you will not be able to pay salaries. Then in that case, what can happen is, even though you are getting 8.7 crore valuation here, you might be willing to close the deal at 7.5 crore valuation just because you want the money in the bank ASAP, right? So from here on, negotiations, kind of take over, and then we are able to kind of close the transaction. A lot of times, investors work on something called as, thumb rules, right? So over a period of time, they have done so many deals that they would come and tell you that, you know what, at your stage with your revenue, typically we will take 15% stake in the company, or typically we will take 18% stake in the company. How have they arrived at it? They have done this so many times that now these numbers are basically sector wise and company wise numbers are what are behind their, they can actually, they have set a range that this is where I will do the deal, right? So because, I come from the investment background in startups, you pick up a sector and I'll be able to tell you that what multiples are going on right now, what will be the valuation that you can expect, right? But this is what essentially the founders have to calculate to essentially get to a valuation number, right? Um, so I'm going to take a few questions, and there are a lot of questions on the chat window. Let me just take a few questions here. One question: where exactly in the website can I get the industry standard revenue multiple? Unable to find it. So, Tulika, if you are looking on Fundenable website, look at Fundenable platform subscription on the top right. On Traction, you will be able to find it, again, somewhere at the top right to subscribe. Just check Venture Intelligence or VCC Edge. Multiple platforms are available, right? And where do these platforms get the data? Every time you raise a round of capital, you have to actually, submit your documents. How much money have you raised? What is the round value? All of that to the ROC website, Ministry of Corporate Affairs, right? So all of us download it from there. You can pay some money, download those reports, and then provide those reports in essentially tabulated formats like these, right? So that is what happens. Um, can you explain post money valuation again? How that 1 crore figure is reached? See, very simple again for everyone. Revenue multiple multiplied by the ARR will give you a valuation number. Now consider this valuation number as a pre-money valuation number. Okay. And now this valuation number is before I put in money in the company. So if today the valuation of the company is 7.7 crores and I put in 1 crore in the business, then the total value of the company will become 8.7 crores. Where is the 1 crore coming from? 1 crore is the amount of money that I was looking to raise from the investors, right? This 1 crore, the investment amount, right? So pre-money valuation, which is found out by revenue multiple multiplied by revenue, you add that 1 crore to get post-money valuation, and the stake calculation happens by dividing the investment amount, what I put in, divided by what is the value of the company, what investor has put in divided by what is the value of the company, and that gives you the percentage stake or the dilution that you have to essentially look at, right? How do we get 16x as revenue multiple? 16x revenue multiple comes through this table, which we went through. This number, median, right? So I've taken basically a median of this table, which came from platforms like Venture Intelligence, Traction, Fundenable, etc. And then we were able to find this. These are comparable companies, companies that are similar to me, similar to my business model, right? Those are the places, that is where the revenue multiple essentially came from, right? Let me see if there are a few more questions that I can take. Sonika is asking if the valuation is done for the first time. Okay, what do we mean by first time? That let's say there are no comparables. I am the only company in the market which is doing something like this. Then what you have to do is you have to kind of just be more lenient in terms of your searches, right? You will not get exactly similar companies. So, for example, Agri Insights is just a SaaS platform providing insights to farmers, right? So it is not exactly similar to me, but the business model is I'm taking a technology product and selling it to the farmers, right? So you will not get exactly apples to apples comparables. Try to kind of just see that in my sector, in my stage, what are the kind of multiples that are going on. And then on the base valuation number, you can ask for a premium that because I have these features, this technology, I have patents, IPs, I am asking for a premium on this 8.7 crores, a 20% premium on this 8.7 crores, right? That is a part of negotiations per se. What about raising money? Nitya is asking, what about raising money via safe notes, etc. I'm going to cover that, and I will discuss that as well, right? Um, Okay. So Tulika is asking, can you share current standard revenue multiple of skincare D2C brand? Skincare today, you will get a revenue multiple of anywhere between 3 to 5x. It used to be very high a few years before, but because there have been a lot of failures recently, and customer acquisition costs have been really, really high. If you are able to get a multiple above 5x in D2C, it will be considered really, really good at this point in time per se, right? Um, Great. So now what I'm going to do is I'm going to actually move on to the next segment where what happens typically is that your revenue, your business model is actually a mix of two or more business models. It's not as straightforward, right? So the company that I exited, Origa, what it did, okay, so we were buying and selling of used equipment. We were a B2B e-commerce platform which used to buy and sell used equipment. So let's say I have a used machinery which is there in my factory and I want to sell it. So you could just go on this platform and you could sell that machinery. But we were also financing that equipment. So there was an NBFC business also. So it was not just a e-commerce business. It also had an element of NBFC where we were basically financing that equipment which you want to purchase, right? So in this case, what was done was we found out what is the revenue multiple for B2B e-commerce, and that came out to 13x. We also found out what would be the revenue multiple for a NBFC business or a leasing business, right? And that came out to 6x. And then we calculated a blended multiple. What is a blended multiple? Weighted average. Because 80% of my business currently was B2B e-commerce and 20% of it was more of NBFC, we calculated weighted average. 80% of 13x plus 20% of 6x, that came out to 11.6x, right? And we used a blended multiple of 11.6x to calculate the valuation of the company. So many times, if your business model is a combination of two or three business models, that I am a D2C brand also, but I have subscription business also, then you can actually look at blending the multiples and coming up with your own multiple to find out the valuation of the company per se, right? Uh, Now, what if the startup does not have revenue, right? So a lot of you must be revenue generating, but in many cases, a startup that does not have revenue, how do they get valued? How can we value those companies which don't have any revenue? Or at times, what happens is if the investor and the founder, what if investors and founders do not agree on the valuation number, right? So I like the investor as a founder, investor has really liked the company, but we have not been able to reconcile on the valuation number per se, right? Then how do I essentially, how do I essentially look at the revenue, look at valuations per se, right? In this case, what you do is you get into convertible structures, and these are very important for us to understand, especially early stage businesses. What are convertible structures? Convertible structures, anything which you see which you have a CC written in front of it, right? A CCD, which is a compulsorily convertible debenture, or a CCPS, a compulsorily convertible preference shares, or a convertible note. Or a lot of people, Y Combinator coined this whole concept of safe notes, simple agreement for future equity, safe. All of these things, CCD, CCPS, safe, convertible notes, all of them are based on the concept of convertible structures. Now let's understand how do convertible structures work. What am I going to do? I am going to invest. Now in this case, okay, you don't need to fix any revenue multiple. Whatever we studied in the past 40 minutes or so, just forget that completely. So here, you don't need to fix any revenue multiple. You don't need to define valuation at this point in time at all. No valuation defining, no revenue multiple fixing, nothing. What I'm going to simply do is I'm going to actually take that 1 crore rupees from the investor. Okay. So I'm going to tell the investor, you give me 1 crore rupees, but today I am not giving any shares against that 1 crore. Today, we are not defining how much percentage you will own in the company, which means today we are not defining valuation. We are postponing the problem of valuation until the next round of funding, right? So you give me money, I'm going to start utilizing the money. I will keep that money temporarily as debt or in the form of loan, but that loan will be a zero coupon, zero interest loan. The objective of that loan is not to make money through interest. It is just a temporary arrangement. So you give me 1 crore, I will park on my balance sheet as loan. I'll start using the money, but I'll not give you any stake. The stake will be calculated on the basis of the next round of funding, right? So let's say 1 year later, as a founder, I raise second round of funding at a certain valuation. Now the valuation has been discovered, right? By the second round of funding, we have revenue, we have traction. So investors can define the valuation, right? So that valuation, which we will get at the second round of funding, we will use that as a benchmark for you. But because you have come in earlier, right? As an investor, you have come in earlier, a year earlier, I will give you a certain discount on that valuation just because you have come in earlier. And that discount is what we negotiate, which in this case I have kept as 30%, right? So what we are doing, we are postponing the problem of valuation to the next round of funding. The investor is putting money, we are utilizing the money. At the next round of funding, the valuation discovery will happen. And that valuation, we will apply a discount on that valuation for our first investor, and we will convert that 1 crore into equity. So this 30% discount is a negotiated number. How will it work mathematically? Let's look at it. Okay. So what am I doing? I am basically raising 1 crore rupees of capital. And after 12 months, the startup raises 7 crores at a 35 crore valuation. How did I get a valuation at that point in time? But by then I had revenue, by then I had users, everything was there. So this 7 crore investor was able to define the valuation, right? So what happened? 1 crore rupees invested, no stake given, but 12 months later, 7 crore rupees invested by another investor at a 35 crore valuation. So now what will this 1 crore investor do? This 1 crore investor will apply 30% discount, which was a pre-negotiated, pre-agreed discount number on this 35 crores. So if I apply 30% on 35 crores, I get a number which is 24.5 crores. So the valuation now for my first round of investors is 24.5 crores. And at this valuation, 1 crore rupees of investment will get converted into 24.5 crore rupees of valuation, and I get 4.1% equity in the company. So what I technically did was, I postpone the problem of valuation till the next round of funding. Whatever was the valuation of the next round of funding, I applied the pre-negotiated discount on it, and then I converted 1 crore into equity, thereby taking 4.1% stake. So any company who's difficult to figure out what the valuation should be at this point in time, either because they don't have revenue, enough traction, for all of those companies, convertible structure is a very good option that you can use, right? But this, this model has a very big problem. And can someone kind of, find out what is the problem? Can you figure out what is the problem? Can you kind of think what would be the problem? Any idea? Any thoughts? Uh, Risk to investors, okay. How cap and floor will work? I'll talk about it. Fixing the discount. These are all problems, but a very, very large problem. Think from the investor standpoint, what can go really wrong, right? Thing which can go really wrong is what if the startup is not able to raise the next round of funding, right? What if, like Amit is mentioning, right? Suppose, what if the next round of funding doesn't happen? What have I done? I have basically put in money, and I'm saying valuation will be determined by the next round of investor. But what if the next round of funding doesn't happen at all? Then what we do in that case is we fix up something called as a floor valuation, right? So if the startup does not raise a round of funding within a stipulated time period, then automatically my 1 crore rupee will get converted at the floor valuation. And floor valuation also is decided upfront, right? So let's say if I fix a floor valuation of 8 crores and I give a time period of 3 years. So what am I telling the founder as an investor? That you know what, you will get a time period of 3 years. Whatever you want to do, you have to do within a time period of 3 years, like next round of funding. But if until 3 years you have not been able to raise a round of capital, then I will convert my 1 crore at 8 crore valuation, thereby taking 12.5% stake in the company, right? See, if the company fails, then nothing can be done, right? Then obviously the investment goes down the drain. And that is the rule of startup investing, that there are a lot of failures. And if a startup is failing, then anyway, the money is going down the drain. But if the startup has failed to raise a round in a stipulated time period, then automatically floor valuation will be applicable. Typically, the floor valuation number is a very, very low number to penalize the founder for not being able to raise a round and thereby taking a higher stake in the company. But in any case, try and understand, investors are not interested in higher stake because 50% of zero will be zero, right? So this structure is just to kind of put pressure on the founder, saying that, hey, you know what, you need to raise the next round of funding soon, right? The floor valuation is decided right at the time of angel funding, right at the time of first round of funding, right? Whenever you are getting into a convertible structure, it is decided at that point itself. How does one calculate floor valuation? It is very arbitrary. Typically, floor valuation will get investor around 25% stake in the company, 25 to 30% stake in the company. Very large, right? And that is where floor valuation plays a very critical role, because it is only applicable in a situation where the startup is not doing really well and it fails to raise the next round of funding, right? Now, just the way there is floor, on the other side, there is something which we call as cap. Now, what is a cap valuation? Try to understand, what if the startup raises the next round of funding at a 250 crore valuation? Let's say you become super hit, right? Investor has invested 1 crore and suddenly you get market tailwinds, or you've cracked the product really well, and you became a 250 crore valuation company, right? In that case, the investor will get converted at what value? 30% discount to 250 crores, which is 175 crores. And my 1 crore of investment will get converted at 175 crores, thereby giving the investor 0.57% stake in the company. Now the investor will say that, boss, I invested in your company when no one was ready to invest, when you were at a very early stage, and now you are giving me only 0.57% stake in the company, right? Just 30% discount, 0.57% stake in the company. This is not done. So what the investor does, investor fixes a cap. The valuation cap in this case, let's say, is 40 crores. Again, how is it fixed? Typically, for a seed round, valuation cap is somewhere between 50 to 60 crores, 40 to 60 crores, I would say, right? So if the valuation cap is set at 40 crores, then what will happen? If the next round of funding happens at 250 crores, we will not use this 30% discount to 250 and convert at 175. We will simply convert 1 crore at 40 crore cap, and the investor will end up getting 2.5% stake in the company. So instead of getting 0.57% stake, the investor actually has got 2.5% stake because of the cap. So the bare minimum stake that the investor will get in the company is at the cap, which is 2.5%. The maximum stake that the investor will get in the company is at floor, which is 12.5%. And for any other case, it will be between 2.5 to 12.5. Discount will be applicable, right? 30% discount will be applicable in case the next round of valuation is lower than the floor person, right? One last thing that I want to actually discuss, and one last level of complication that I want to actually talk about is you can have different discount rates for different years. So what the investor typically asks is that, okay, after I put in money, if you are able to raise the next round of funding within 1 year, then 30% discount. But if the next round of funding happens in the second year, then a 35% discount. And the next round of funding happens in the third year, then 40% discount. So the more you are making me wait, the higher is the discount percent. You do a round quicker, lower discount, but you take a lot of time, higher discount. And after 3 years, floor will be applicable, right? If you are not able to raise a round of capital, floor will be applicable. And at any point in time, if your next round of funding is above the cap, then the cap will be applicable. So a typical convertible structure is divided into a floor, a cap, and differential discounts for different years. This is the most complicated convertible structure that one can look at, right? So essentially, what we saw is two things, right? One, how to value companies which are essentially making some bit of revenue. And there we understood a method called revenue multiple method, where you are comparing multiples basis the transactions that have happened recently, same stage, same sector, similar rounds of companies. And then we took a median, and then we actually calculated the valuation by multiplying it with our ARR. The second phase, the second type was, if I don't have revenue, then I'm actually calculating it using convertible structures, right? There are a lot more methods. A lot of times what people do is they also use revenue multiple method if they are not revenue generating. How? They will apply the revenue multiple on their projected number, right? They will tell the investor that 16x is the revenue multiple, 2 crores is my projected revenue. So, my valuation is going to be 32 crores, right? But typically it doesn't fly. Investors don't really accept that. But obviously you can give it a try, and you can also value companies at a projected number, 1 year projected number. One method which I learned in the US was user-based valuation, which means what we do is, instead of calculating revenue multiple, we calculate valuation per user. So let's say, just giving you a random example, right? Netflix has 350 million users, and the valuation of Netflix is $1 billion. So what I'll do, I'll divide 1 billion by 350 million, and I'll get a number, and that number will be valuation per user, right? Let's say that number comes out to $20. I have 10,000 users. What I'll do, I'll multiply my 10,000 users with $20 valuation as per user valuation and come up with my valuation, right? So multiple methods keep on evolving. Silicon Valley is where all these methods keep on kind of evolving. And we then get to kind of, look at it and we use it. But the most, I would say, commonly used method is the revenue multiple method, right? Um, so yeah, also there is a method called discounted cash flow method, DCF, which is the classic valuation method, which you will see all in your finance books, etc. But typically that method is not what we use for startups, right? It's a very complicated method. It's based on free cash flows. As startups, we are not going to generate profits for the next couple of years, maybe forget about free cash flows. So therefore, it is not very suitable for startups. And that is the reason why we don't typically use that method per se, right? I'm going to take a quick pause and see if there are any questions per se. Uh, at what valuation range does cap come into effect? So, Bindu, like I said, if the next round of funding breaches the cap, then for the first investor, he will not apply discount to that next round, but will straight away convert at the cap number, right? I gave you an example. How does it work? Um, what about valuations based on revenue projections? Soumya, I just answered that question. Revenue you can, but see, the thing is that revenue projections, now investors have obviously burnt a lot of fingers and they understand that projections are just numbers on the Excel sheet, right? Uh, you are valuing a company basis what is the projected number, and if it doesn't fall through, it doesn't come through, then it all goes down the drain, right? Uh, there is one thing which I want to tell you here is certain sectors are what we call as flavor of the season sectors. Example right now, AI. AI is the flavor of the season, right? If you are a startup which is fundamentally building models in AI, then none of these rules possibly will apply. You will get valued at a certain number right upfront without any revenue possibly. And that is what is happening also across the world, right? But these are all outlier situations. Don't try and apply those situations onto you. Let's say if I'm a retail company, I shouldn't get kind of inspired by the fact that, oh, someone raised money at zero with no revenue at this valuation, right? Typically, when this happens, when a lot of companies raise a lot of capital at zero revenue very initially, then you have to understand two things. Either it is the flavor of the season, or the founder is coming from a background where he or she has given multiple exits previously to the investors and has started this is like his or her second business, right? So always remember, when Hector Beverages started their the company, these were ex senior members of Coca-Cola team. So on day one, because of their pedigree, because of their background, people invested at a very high valuation upfront, right? Or when Mukesh Bansal, after selling Myntra to Flipkart, started CultFit, on day one, he was able to raise money at a very large valuation. So when you see such stories, either it is the flavor of the season, like what is happening in the AI, or the founder is coming with a very good background of exhibiting, giving exit to the investors previously per se, right? Um, Harsh is asking any insights on retail as a service model. Not really. We'll have to double click on that. Nitya is asking, can we set floor valuation based on projections? For example, if we have projected 10 crore ARR after 5 years, then the floor valuation can be 10 crores. No. See, revenue is nowhere, you are equating revenue with valuation. You are saying after 5 years, I'll make 10 crore rupees revenue, and that 10 crore revenue should be my floor valuation. That is incorrect, right? That is not how it will work. Floor valuation, the objective of floor valuation is if in the next 2 to 3 years you are not able to raise a round of capital, then the convertible debenture or a convertible preference shares have to be converted into common equity, percentage stake, right? That has to happen at some valuation. So that has to be defined today. And it's a very low number to penalize the founder for not being able to raise a round of capital. So that's the see, if you are a founder, I don't think you should be worried too much about floor valuation. You should be worried about the cap valuation, because floor valuation, let's say if you don't raise a round in the next 3 years, then something is wrong, right? Like something has not worked. But you have a very high chance of raising a round at a very high valuation, which is at the cap, right? So worry about the cap. Don't worry too much about the floor is what I would suggest. Um, Suresh is asking a very important question. Before the second round, what if the company gets acquired? Right? At that point in time, valuation will again be decided basis revenue multiple or any of the methods that we saw, right? And if there are convertible debenture holders or convertible preference shares holders, then they will get converted at that valuation at which it is getting acquired, right? So always remember, revenue will be a key driver for determining valuation. Only if you are in sectors like pharma, defense, space tech, possibly acquisitions will happen even before revenue, right? There they have patents, technology, and that plays a very critical role in coming up with valuations, right? Soumya is asking, valuation has to be mutually agreed upon by the founders and the investors. Yes. Uh, Nihal is asking about OCPS. Okay, so what we saw right now is CCD or CCPS, compulsory convertible debenture. OCPS is optionally convertible or optionally convertible debentures, like OCDs. There, the investor has two options: either to take interest and treat it as debt, or to treat it as equity, right? But OCDs, OCPS, any of these are not used in startups very frequently. Like in my 15 years, I have not done a single OCPS or an OCD transaction, right? It's just not the norm. Uh, on conversion, tax is not applicable. On liquidation, tax is applicable. Always remember that, right? Uh, Ajay, okay, I'm in RT slightly long. Let me come back. Um, Chinu Raj is asking, is there a convertible with right to call at any point in time? You can fix that, right? And you can actually, you can actually look at OCPS or OCD where you can actually call it back, right? Does the valuation apply to acquisition? And also, does it get affected based on cash settlement? Ashok, I have not understood your question properly. Try to reword it, and I'll possibly try and answer that, right? Um, Great. So this is how essentially, in a very quick and easy way, valuation works. I want to touch upon one very important concept before we close, and that concept is again extremely critical for all of us as founders to understand before we start, before we start raising a round of capital, or before we actually, even reach out to investors per se, right? And that concept, I want to start by asking you a question. Like, okay, today, if you raise a round of capital from an investor, in the next 5 to 7 years, what is the, what is the stake, or what is the return that you are willing to give to that investor, right? So let's say the investor invests 1 crore rupees in your business today. How much X, right, are you willing to give over the next 5 to 7 years to the investors? 2x, 3x, what would that be? Any thoughts? Any ideas? You can put it on the chat window. How many X will you be giving as returns? I'm not talking about the multiples or anything, right? That if I give you 1 crore rupees in the next 4 to 7 years, what is the money that you will be giving me back as an exit proceed, right? So, Harshada is saying 10x, Harsh is saying 4x, 5 to 10x is what Pankaj is saying. Great. So we have lot of answers, right? 2 to 3x, 20x. Okay, so we have a full range. Now let me actually discuss this with you, and let me actually explain this concept. And for this concept, for understanding what is the investor expectation in terms of valuations, in terms of returns, we have to go back to our um, possibly fifth or sixth grade mathematics class again. And the investor expectation is hidden in that fifth grade or sixth grade mathematics class, right? So we need to understand a concept called power law in venture capital. If you are trying to raise a round of capital, one concept that you need to understand in and out is this concept called power law, right? And I'll share some books also at the end of the session, which you can go through and you can actually read a lot of these concepts which are applicable on us as companies who are looking to raise a round of capital, right? Now, what is power law? Before power law, all of us would have seen this bell curve, right? Symmetric distribution, or what we call as normal distribution. Now, what is normal distribution? Giving you a quick example. Let's say if I measure the height of 10,000 people and I take an average, and that average comes out to 5 feet 7 inch, right? So I go out, I measure the height of people, 10,000 people, and take an average, and that comes out to 5 feet 7 inch. Now, out of this classroom, I randomly pick up one of you. There will be a very good chance, a very high probability that you will be around 5 feet 7 inch. And there will be a very, very low probability that we see a person who's suddenly 7 feet or 7.5 feet, right? All of us will be clustered around the average, around this 5 feet 7 inch, right? And this is what normal distribution is all about. So if startup investing followed normal distribution, then what could I do as an investor? I could basically measure the returns that startups have given in the last 5 years. I would take 5,000 startups, take the returns that they have given in 5 years, take an average. And let's say that average return has come out to 30%. Now I randomly pick up any one of you and invest money in you. There would be a good 68, 70% probability that I will get a return which is very close to 30%. Randomly, I pick up one of you, invest in your company, and there would be a very, very high probability, 70% probability that you would give me 30% return. But unfortunately, raising a round of capital or startup investing does not follow bell curve distribution or symmetric distribution. It follows another statistical distribution, which is called the power law distribution. And how does power law look like? Power law looks like this. It is basically skewed outcome distribution. What am I doing right now? Let's understand this. It's a very powerful concept for all of us, especially entrepreneurs, right? Because we have left our normal distribution lives and have become entrepreneurs, have entered power law distribution lives. I'll explain, right? So as an investor, I am plotting number of my investments on the y-axis. These are my number of investments, 5, 10, 15, 20, right? 20 investments. And on this side, on the x-axis, I am plotting the returns that I'm getting from my investments, right? I'm plotting returns that I'm getting from my investments, like no returns, 10% return, 5% return, 100% return, right? Now, what you will see is, if you observe this, a very, very large number of investments, On y-axis, I have number of investments. So very, very large number of investments are actually going to give me very, very low returns. See, returns are on the x-axis. So large number of investments on the y-axis are going to give me very, very tiny or almost no returns, zero returns. And on the other hand, very, very tiny number of investments, small number of investments are actually going to give me a very, very high return, right? So the way power law works is that most of the investments that I do, they are going to fail. If I do 20 investments, 18 are going to fail and 2 are going to give me money. So if you are a successful founder, if you are amongst those two, what is your job? Your job is to not just give me returns, those 2x, 5x, which you have mentioned on your investment, but you also have to compensate me for all of my failed investments. Otherwise, where is the money going to come from? Right? Where am I going to make money on those failed investments? That also has to come from you, right? So if I were to get good returns from all the companies, 2x, 3x, 8x would be very good. But because I am going to get returns only from a few companies, those few companies have to compensate me for all of my failed investments so that at a portfolio level, I will be able to beat the stock markets. Why am I investing in startups? I'm investing in startups because I want to make alpha. I want to make more money than what I would make by investing in startups, investing in stock exchange, right? Stock market. So that if I have to do, then you who are the winners have to give me super normal returns. And those returns have to be upwards of 30x, 40x, 50x, 100x. Only then at a portfolio level, I will be possibly able to make 25%, 30% on an annualized basis. So try and understand the expectation from you in terms of valuation growth, in terms of returns, is not 5x, is not 2x, is not 3x. I would expect a 35, 40x, 50x. I would want some of my companies to deliver a 300, 400x returns. And that has happened. That is possible. And that is the game. A lot of times founder pitch to me and say, sir, I'm a very safe investment. Try and understand, I'm not looking at safe investments, right? The reason why I'm investing in startups is I want few big winners. I understand that all my investments are going to go down the drain, but those few winners are going to compensate because power law is at its best in investing in startups, right? Similarly, running a business, right? Running a venture. Out of the 100 things that you are going to do, 80, 90 of them are going to fail. Only those 5, 10 things are going to work, but those 5, 10 things are going to give you so much of return, so much of success that, it's going to be, basically, it's not going to be under the normal distribution, right? It is skewed. The outcomes are going to be skewed. So therefore, when you show projections, okay, a lot of times startups pitch, they talk about great things and they show projections. How are the projections? First year 2 crores, second year 3.5 crores, third year 4.5 crores. By fifth year, they will be a 8.5 or 9 crore revenue company. If this is how you are going to grow, you will not fit into power law. You have to become 200, 250, 300 crore company in the next 5 to 7 years, at least to fit into the power law. And for that, you need to have a scalable business model. Your business model itself has to scale to such an extent that you will be able to make that much revenue per se, right? A lot of times people say that, oh, this is not sustainable, this is not right. But that's perspective, right? But this is what this asset class chases. And this is what you need to actually keep in your mind while you are entering any kind of discussion with, with investors. Most of the times, we fail to invest or we don't want to invest in founders because we are not seeing power law in that particular company taking effect, right? Either the founder has not understood it or the business model is not scalable. It will not be kind of scaled quickly. It will not be able to, and at times founders have not presented it saying that, you know what, you are looking for few big winners and I am one of those. I will be like super big winner for you, right? That is what the pitch is all about, right? To the investors. And that is where you will have to really look at, in your pitch as well, right? So Pratika is asking for capital intensive business, should we go with revenue multiple valuation? No. So for capital intensive businesses, you can go with revenue multiple, but typically you go with EBITDA multiple or discounted cash flows, right? So instead of valuation divided by revenue, calculate valuation divided by EBITDA, which is your operating profit, and then look at the number. Or you can look at DCF in case you are actually making enough revenue going forward, right? Does the ROI for investors comes through valuation of the next round? Yes, it comes through the valuations of the next round and ultimately through exits. When either the company goes for an IPO or an acquisition happens, that is when you are able to actually make a lot of money per se, right? What I'm going to do right now is, guys, that typically what happens is that as startup founders, we just discussed few topics, right? We discussed valuation, we discussed power law. Last week, I took a session on unit economics, right? So one thing that as founders, we grapple with always as a problem is upar wali soch, is what I call it, which means you have to constantly break your glass ceiling. You have to constantly keep learning, constantly applying newer and newer mental models to business. When we were working in jobs, there was our boss, colleagues who were helping us out, right? But now we are all alone. And it is very easy to kind of hit a glass ceiling when you are working alone as founders. And what plays a very important role is basically reading a lot of relevant books, right? So what am I going to do? I'm actually going to paste my top list of books on the chat window. Please, pick up these. These will change the way you are looking at the business. All written by practitioners, right? All written by people who have scaled businesses, done businesses, and it gives amazing insights. And over a period of time, you will be able to connect whatever you have read between these 15, 20 books overall, and then build your own business model, build your own Melton models. If you are not into reading, you can actually go to my LinkedIn profile, and I have actually given 2-pager summaries of all the books that I've read and whatever I keep reading. And I only read predominantly those books which are relevant for founders per se. So I've also shared my LinkedIn profile. So if you go there and just scroll down, on all of these books, you will find 2-3 pager summaries, right? So the gist of it is what you will get to know. Last year, I remember one of the books that changed the way I was thinking was Almanac of Naval Ravikant. You must pick that book if you are just starting. I would recommend pick that book and start, and then go to maybe things like Power Law or Secrets of Sandal Road or Startup Code, right? It will really change the way you think. If you are not into reading books, if you don't even like to read the summaries that I've written, then I'm going to I have pasted uh, a few movies and a few web series that you can actually watch, right? One of my favorites is this web series called We Crashed, which is the story of WeWork. It is available on Apple TV. And I also loved watching The Playlist, which is basically the story of Spotify. And that is available on Netflix. So if you've not watched it, do watch it. And if you want to make fun of the whole venture capital ecosystem, then I've not put it out here, but there is a very nice web series, very funny comedy series called Silicon Valley. So you can, that's on, I think, Hotstar, right? So see, reading a lot, right, is going to help you in taking your business to the next level. It might sound stupid and very, very, academic, but trust me, it will help you a lot in coming up with newer and newer mental models per se, right? So yeah, I mean, these are some of the things. Stay tuned. NSRCEL keeps conducting a lot of such programs, a lot of such webinars, and you will keep getting updates through the WhatsApp group. In fact, I have also joined the WhatsApp group to stay updated. That's it from my side, everyone. Thank you so much. Feel free to reach out to me on LinkedIn. Always available to help you guys when it comes to capital raising, investments. Happy to look at some of you from investing standpoint. And Savita, thank you so much for giving me one more opportunity to talk about an interesting topic with a bunch of people who were very, very, kind of engaged. Thank you so much.
No, I must say thank you, Vikrant, for taking out the time to do this. I think within an hour, within the week, you've spent about 3 hours with our founders doing these sessions, and that's very kind of you to take the time out. And you break it down into such understandable pieces that founders from all segments are able to understand it. So that's extremely kind of you. Thank you so much for taking the time out to do this. And yes, I hope we can do more sessions in the future together.
Thank you. See you all. Bye. Have a good weekend.
Thank you all. See you.